Changes in accounting policies. First of all, what do we mean by accounting policy? Accounting policies are nothing but specific accounting principles and method of applying those principles when we prepare and present financial statements, right? When accounting policies can be changed. Accounting policies can be changed when it is required by statute, say law, when it is to ensure compliance with accounting standard, or the change in accounting policy would result in even more appropriate presentation of the financial statements. So three circumstances: one is statute, two is accounting standard, three is more appropriate presentation of financial statements. What does not constitute change in accounting policy? That's what we are going to understand. When you adopt an accounting policy for an event or transaction which differs in substance in previously occurring event or transaction, that does not amount to change in accounting policy. I repeat, when we adopt an accounting policy for event or transaction which differ in substance with respect to previously occurring event or transaction, it does not amount to change in accounting policy. Example, let's say enterprise introduces formal retirement gratuity scheme instead of ad hoc ex gratia payments to employees on retirement. Okay, so because this formal retirement gratuity scheme has applied for the first time, because there is no past or there is no precedence, we cannot conclude this as change in accounting policy. Okay, so this is one scenario which we have to understand. Similarly, when we adopt an accounting policy for event or a transaction which did not occur previously or it is immaterial, then that also does not amount to change in accounting policy, right? What are the disclosures required? If the change in accounting policy is going to have material effect, then the impact of change and adjustments as a result of change in accounting policy have to be shown in financial statements in the period in which change takes place. Okay, again I repeat, when there is a change in accounting policy and if it is having material effect, then the impact of change, resulting adjustments, everything have to be shown in financial statements in the period of change. And if the effect of change is not ascertainable either fully or in part, then we have to indicate the fact that it is not ascertainable. And if it is not going to have any material effect in the current period, okay, let's say the change in accounting policy is not having any material effect in the current period, but it will have material effect in later periods, then we have to disclose the fact in period of change. We have to disclose the fact that accounting policy has been changed, there is no material effect in the current period, but in later periods there will be material effect.